If you have ever worked hard, paid your bills, followed the rules, and still felt like the system is stacked against you, then stay with me, because the way money worked 2,000 years ago might explain why modern people feel more stressed, more indebted, and more insecure than ever. And it also reveals practical lessons that still matter for your paycheck, your savings, and your future today. When we talk about the time of Jesus, many people think only in spiritual terms, but that world was also an economic system, and not a fair one. Most people lived paycheck to paycheck, except there were no paychecks, only daily wages. A worker would go to the marketplace at sunrise hoping someone would hire him for the day. If he didn't get picked, his family didn't eat. There were heavy taxes imposed by the Roman Empire, local rulers, and religious authorities, sometimes taking more than half of a person's income. Debt was common and dangerous. If you couldn't pay, you could lose your land, your tools, or even your freedom. In that environment, Jesus spoke constantly about money, debt, wealth, work, fairness, and responsibility, not because money was evil, but because money controlled people's lives. The modern economy is obviously different, but the pressure feels similar. Many Americans today live with unstable income, rising prices, heavy debt, and a sense that no matter how hard they work, they are falling behind. That is why looking at the economic lessons from that time is not about religion. It is about understanding human behavior, power, incentives, and survival in a system where resources are limited and rules are not always fair. One of the first lessons from that time is the importance of daily cash flow over abstract wealth. In Jesus' time, people didn't think in terms of net worth, retirement accounts, or long-term portfolios. They thought in terms of daily bread. That phrase wasn't poetic, it was practical. It meant having enough cash or food to survive today. In the modern economy, many people focus on big numbers like home value, stock market highs, or future retirement balances, but ignore their day-to-day cash flow. You can own a house and still be broke every month. You can have a good salary and still live in constant stress because your expenses rise to match your income. The lesson here is simple and very modern. Financial stability starts with controlling daily and monthly cash flow. Before investing, before side hustles, before thinking about wealth, you need margin. You need breathing room between what you earn and what you spend. People in Jesus' time understood that survival depended on this margin, even if it was small. Today, margin protects you from layoffs, medical bills, inflation, and unexpected life events. Another lesson from that era is the danger of debt when income is uncertain. Debt in ancient times was not just numbers on paper. It was personal. Creditors knew you. If you couldn't pay, consequences were immediate and severe. While modern debt doesn't usually lead to prison, it still controls choices. Student loans delay family formation. Credit card debt eats future income. Car loans lock people into jobs they hate because they need the paycheck. Mortgage debt ties people to geographic areas even when better opportunities exist elsewhere. The lesson is not that all debt is bad, but that debt is a claim on your future labor. In a world where income is less predictable than ever, with gig work, layoffs, automation, and AI disruption, taking on debt without a clear plan is risky. People in Jesus' time feared debt because it could take everything. Modern people normalize debt because the pain is delayed, but the loss of freedom is still real. Another powerful idea from that period is the concept of stewardship rather than ownership. Most people then did not own land. They worked land owned by others. Wealthy landowners hired managers to oversee resources. Jesus often told stories about stewards who were trusted with resources that were not theirs. In modern terms, this is incredibly relevant. Most people today are stewards of money that flows through them. Your salary is not permanent, your job is not guaranteed. Even your savings are influenced by inflation, market risk, and policy decisions. Thinking like a steward means managing resources responsibly, not assuming they will always be there. It encourages emergency funds, and skill development. It discourages reckless spending based on temporary income spikes. In the digital economy, where income can change quickly, stewardship is a survival skill. Another lesson is the value of diversified effort. In ancient agrarian economies, relying on a single crop was dangerous. Drought, pests, or weather could destroy everything. That is why people often grew multiple crops or combined farming with fishing or trade. This idea shows up clearly in ancient wisdom that warns against putting everything into one field. Today, this translates directly to income diversification. Relying on one employer, one skill, or one industry is risky. Layoffs, automation, and market shifts can wipe out income overnight. Diversifying doesn't mean chasing every trend. It means building multiple income streams over time, such as a primary job, a side skill, investments, or digital assets. It also means diversifying investments instead of betting everything on one stock, one crypto asset, or one real estate deal. The economic logic is the same now as it was then. Uncertainty is constant. Diversification reduces risk. Another lesson is the importance of delayed gratification. In Jesus' time, storing grain was a matter of life and death. People who consumed everything immediately were vulnerable to famine. Those who planned ahead survived hard seasons. This principle applies directly to saving and investing today. Inflation pressures people to spend quickly because money feels like it loses value over time. Advertising encourages instant gratification. Buy now, pay later has become normal. But delayed gratification is still the foundation of financial stability. Saving a portion of income, even when it feels small, creates options. Investing patiently allows compound growth to work. Avoiding lifestyle inflation preserves margin. The modern economy rewards patience, even though it constantly tries to distract you. Another lesson from that era is understanding the power imbalance between labor and capital. In Jesus' time, landowners and tax collectors held most of the power. Workers had little leverage. That reality shaped many teachings about fairness, wages, and treatment of workers. Today, the imbalance still exists, though it looks different. Corporations, platforms, and financial institutions hold power through scale, data, and capital. Workers often feel replaceable. Understanding this reality is not about resentment, it is about strategy. It means investing in skills that are harder to replace. It means negotiating pay when possible. It means understanding contracts, benefits, and long-term career paths. It also means recognizing that loyalty to institutions is often not rewarded the way it once was. People in ancient times knew that survival required awareness of power dynamics. Modern workers need the same awareness. Another lesson is the danger of confusing money with meaning. In a society where wealth was visible and unequal, people often equated riches with favor or success. Jesus challenged that idea repeatedly, not by condemning work or productivity, but by warning against letting money define worth. In the modern economy, this lesson is critical for mental health and financial decision-making. Social media constantly displays curated images of success. Luxury lifestyles are marketed as normal. This creates pressure to overspend, overborrow, and overwork. When money becomes identity, people make irrational financial choices to protect their image. Separating self-worth from net worth allows for clearer thinking. It makes it easier to live below your means, invest patiently, and choose work that aligns with your values instead of just status. Another lesson is the importance of community and mutual support. In ancient villages, people relied on each other during hard times. While systems were unfair, informal networks provided resilience. Today, many people are financially isolated. They don't talk about money. They don't share knowledge. They don't build support systems. This isolation benefits institutions that profit from confusion. Learning from others, sharing resources, and building trust-based networks can improve financial outcomes. This can mean learning from coworkers, joining professional groups, sharing tools, or supporting local businesses. The modern economy often emphasizes individual success, but resilience still comes from community. Another lesson is the role of ethics in economic systems. In Jesus' time, corruption was common. Tax collectors overcharged. Merchants manipulated weights. Religious leaders exploited people financially. These behaviors created mistrust and instability. Modern economies face similar issues, though more complex. Hidden fees, predatory lending, misleading financial products, and opaque algorithms all affect people's money. The lesson is to be informed and cautious. Read contracts. Understand interest rates. Question incentives. Choose financial products that are transparent. Ethical behavior is not just moral, it is practical. It builds trust, reduces risk, and creates long-term stability. Another lesson is the importance of productive work over speculation. In ancient times, wealth came primarily from producing real value food, goods, or services. While trade existed, speculation without contribution was often criticized because it destabilized communities. In the modern economy, speculation is everywhere, from day trading to meme stocks to hype-driven crypto projects. While investing is necessary, confusing speculation with investing is dangerous. Real wealth over time comes from owning productive assets, businesses, skills, and systems that create value. This lesson encourages people to focus on learning, building, and contributing, not chasing quick gains. Another lesson is understanding seasons. Ancient economies were deeply seasonal. People expected cycles of abundance and scarcity. They planned accordingly. Modern economies also move in cycles, though less visibly. Booms and busts, inflation and deflation, growth and recession are normal. The problem is that many people assume good times will last forever. They increase debt, reduce savings, and take on risk at the worst moments. Learning to expect cycles encourages preparation. It means building emergency funds during good times. It means being cautious when everyone else is overly optimistic. It means understanding that economic pain is not always personal failure, but part of larger forces. Another lesson is the value of humility in financial planning. People in ancient times understood how little control they had over weather, politics, and health. This awareness encouraged caution and adaptability. Modern people often overestimate control because of technology and financial tools. But pandemics, wars, policy changes, and technological disruption remind us that uncertainty remains. Humility leads to diversification, insurance, flexibility, and continuous learning. Arrogance leads to overconfidence, leverage, and fragile plans. Another lesson is the importance of teaching financial principles through stories. Jesus used parables because abstract concepts were hard to grasp. Stories made lessons memorable and practical. Today, financial education often fails because it is too technical or disconnected from real life. Learning through examples, case studies, and personal experience is more effective. This means paying attention to real outcomes, not just theory. It means learning from mistakes, both yours and others. Another lesson is recognizing that money is a tool, not a goal. In ancient times, money facilitated trade, taxes, and survival. It was not an end in itself. When money becomes the goal, systems become distorted. People exploit others. Short-term gains override long-term stability. In personal finance, treating money as a tool means asking what it is for: security, freedom, time, contribution. This clarity guides decisions. It helps prioritize emergency savings over luxury purchases. It helps choose investments that align with risk tolerance and time horizon. Another lesson is the importance of adaptability. People in Jesus' time adapted constantly to political changes, taxes, and social shifts. Survival required flexibility. The modern economy is changing faster than ever. Automation, AI, remote work, and global competition are reshaping jobs. Adaptability means continuous skill development. It means being open to new forms of work. It means not tying identity too tightly to one role or industry. Another lesson is understanding the cost of inequality. Extreme inequality existed in ancient societies, and it created tension, instability, and suffering. Modern economies also face widening gaps. While individuals cannot control macroeconomic inequality alone, understanding its effects helps with planning. It means not assuming equal opportunity. It means building safety nets. It means supporting policies and practices that increase fairness and stability. Another lesson is the importance of clear priorities. In ancient times, survival forced clarity. Food, shelter, family. Today, distractions blur priorities. Advertising creates artificial needs. Financial clarity comes from defining what matters. This reduces wasteful spending and increases satisfaction. Another lesson is patience and investing effort. Crops take time to grow, skills take time to develop, relationships take time to build. The modern economy often promises speed, but lasting results still require time. This applies to investing, career growth, and business building. Another lesson is the danger of hoarding without purpose. In ancient stories, hoarding during abundance while ignoring community needs was criticized because it increased risk and resentment. In modern terms, this can be seen in excessive risk avoidance that ignores inflation, or in wealth accumulation without planning. Money needs direction. Cash that sits idle loses value. Wealth without purpose can create anxiety. Balanced planning considers growth, security, and contribution. Another lesson is the role of trust in economic systems. Markets function on trust. In ancient times, broken trust destroyed communities. Today, trust in institutions is fragile. Understanding this encourages diversification of banks, investments, and income sources. It also encourages building personal trust through honesty and reliability. Another lesson is recognizing that economic systems reflect human behavior. Greed, fear, cooperation, and generosity shape outcomes. This understanding helps interpret markets and personal finance decisions. It reminds us that emotions drive bubbles and crashes. Managing emotions is as important as managing numbers. Another lesson is the importance of long-term thinking. Ancient teachings often emphasized future consequences. Modern finance also rewards long-term thinking. Short-term thinking leads to debt, speculation, and burnout. Long-term thinking supports education, health, and relationships. Another lesson is the value of simplicity. Complex systems are fragile. Ancient economies were simple but resilient in some ways. Modern finance is complex and opaque. Simplifying personal finances reduces risk. Fewer accounts, clear goals, understandable investments. Simplicity increases control. Another lesson is understanding opportunity cost. Time and resources used for one thing cannot be used for another. Ancient people understood this intuitively. Modern people often ignore it. Every dollar spent is a choice. Every hour worked is a trade-off. Being conscious of opportunity cost improves decision-making. Another lesson is resilience through skills. Tools and money can be lost. Skills travel with you. In ancient times, craftsmen survived disruptions better than those relying on favor. Today, transferable skills provide security. Investing in skills is one of the safest long-term investments. Another lesson is moderation. Extremes create instability. Ancient wisdom often warned against excess. In finance, moderation means balanced risk, balanced spending, balanced work. It reduces burnout and financial shocks. Another lesson is understanding that systems change, but human needs remain. Food, shelter, security, purpose. Financial planning should focus on meeting these needs sustainably, not chasing trends. Another lesson is the importance of clear agreements. In ancient times, misunderstandings led to conflict. Today, contracts govern economic life. Understanding terms protects you. Another lesson is recognizing that money amplifies character. It reveals priorities. Managing money well requires self-awareness. Another lesson is that preparation reduces fear. Ancient people prepared for famine. Modern people prepare for emergencies. Preparation brings peace. Another lesson is that financial education is empowerment. Knowledge reduces exploitation. Learning basic finance is an act of self-defense. Another lesson is that work has dignity. In ancient teachings, honest work was valued regardless of status. In modern times, respecting work helps maintain self-worth and motivation. Another lesson is that generosity can be strategic. Helping others builds goodwill and networks. It is not naive, it is relational capital. Another lesson is understanding scarcity mindset. In ancient times, scarcity was real. Today, perceived scarcity drives bad decisions. Abundance mindset grounded in reality supports better choices. Another lesson is recognizing sunk costs. Ancient farmers knew when to abandon a failing crop. Modern people cling to bad investments because of pride. Letting go is wisdom. Another lesson is the importance of rest. Overwork reduces productivity. Ancient rhythms included rest. Modern burnout is costly. Sustainable work improves financial outcomes. Another lesson is that transparency builds stability. Hidden practices create risk. Being clear with finances reduces stress. Another lesson is adaptability in tools. Ancient people adopted new tools when useful. Modern people should adopt technology thoughtfully, not blindly. Another lesson is recognizing that no system is perfect. Personal responsibility matters within imperfect systems. Another lesson is that financial peace is not about maximum wealth, but sufficient security and purpose. This perspective reduces anxiety and reckless behavior. Another lesson is that teaching the next generation matters. Ancient societies pass down practical wisdom. Modern families often avoid money conversations. Teaching basics builds resilience. Another lesson is that patience during hardship matters. Ancient people endured long winters. Modern downturns require patience and discipline. Another lesson is that planning does not eliminate uncertainty, but improves outcomes. Another lesson is that values shape financial decisions. Being clear about values guides spending and investing. Another lesson is that small, consistent actions matter more than dramatic moves. Ancient farming was daily effort. Modern finance rewards consistency. Another lesson is that awareness of incentives matters. Understanding who benefits from financial products helps avoid traps. Another lesson is that resilience comes from flexibility, not rigidity. Another lesson is that financial independence begins with self-control. Another lesson is that systems reward preparation more than luck. Another lesson is that money should serve life, not consume it. These lessons from an ancient economy are not outdated. They are reminders that while technology changes, the fundamentals of human behavior, risk, and survival remain the same. Applying them today means managing cash flow, respecting debt, diversifying income, investing patiently, building skills, staying adaptable, and keeping money in its proper place as a tool. In a world that feels increasingly complex and unstable, these grounded principles offer clarity, stability, and a realistic path forward for anyone willing to think long-term and act with discipline.